Risk tolerance is falling, risk-taking isn't. You may not realize this, but investing behavior in America is shifting faster than investor knowledge. The latest FINRA Investor Education Foundation research provides one of the clearest snapshots of how investing behavior is evolving in the United States. The findings come from the investor survey component of the National Financial Capability Study, which surveyed more than 2,800 Americans with investment accounts outside of retirement plans. One of the biggest shifts involves new investors. During the pandemic-era investing boom, millions of people entered the market for the first time, but that surge has slowed dramatically. In the latest survey, only 8% of investors reported starting within the previous 2 years, compared to 21% in the earlier cycle. Participation among younger adults has also declined. The percentage of adults under 35 who reported owning non-retirement investments fell from 32% to 26%. Similar declines were observed among men and investors from communities of color. Risk attitudes are changing as well. Only 8% of investors now describe themselves as willing to take substantial investment risk, down from 12% previously. Among investors under 35, that figure dropped from 24% to 15%. But here's where the data becomes interesting. Even though fewer investors say they are comfortable taking large risks, many still feel they need to do so. Overall, 34% of investors believe taking big risks is necessary to reach their financial goals. Among investors under 35, that number rises to 62%. That tension between caution and ambition shows up in actual behavior. Younger investors continue to engage in higher risk activities at much higher rates than older generations. 43% of investors under 35 report trading options, compared with 24% of investors ages 35 to 54 and just 10% of investors age 55 and older. Margin investing follows a similar pattern. 22% of investors under 35 report buying securities on margin, compared with 11% of middle-aged investors and only 4% of older investors. Cryptocurrency remains another important part of the investing landscape. Ownership has remained relatively stable at 27%. But interest in increasing crypto allocations has declined from 33% to 26%. At the same time, perceptions of risk have increased. 66% of investors now view cryptocurrency as an extremely or very risky investment, compared with 58% previously. The study also examined meme stocks and viral investments. Overall, 13% of investors reported purchasing them. Among investors under 35, that figure rises to 29%, while only 2% of investors aged 55 and older did the same. Another major theme is where investors get information. Traditional sources like brokerage research tools, recommendations from financial professionals, and business publications remain dominant. Among younger investors, however, social media plays a much larger role. YouTube remains the most widely used platform for investment information, with 30% of all investors using it. Usage has increased across every age group. The influence of financial content creators is also significant. 26% of investors say they use recommendations from finfluencers. Among investors under 35, that number jumps to 61%. The report also highlights growing concerns about fraud. 37% of investors worry about losing money to investment fraud, up from 31% previously. Yet despite those concerns, 89% do not believe they have ever been targeted by an investment scam. Finally, the study points to a continuing challenge: investing knowledge. On average, respondents answered only 5.3 out of 11 investing questions correctly. Many struggled with concepts involving margin and short selling. Separate fraud awareness questions also revealed that roughly half of investors failed to recognize common warning signs associated with fraudulent investment offers. Taken together, the findings reveal a market where access to investing has expanded dramatically, but education has not always kept pace. And here's the real takeaway: more access to investing doesn't automatically mean more understanding. That gap is the real story behind the data.